Let's go to the edge of the trading floor in Chicago, and Oliver Slope, Blue Line Futures, here with us. And yeah, he's got his corn tie on. Must be report day. What are you hearing from the floor today?
Well, it is report day, and there's a lot of anticipation and hopes that we finally get some new news to really kind of give this market new direction other than sideways. But historically, this is a relatively mute report. So if history is any mirror of itself, we expect the attention to be kind of back on money flow and technicals by the end of the day. For that corn contract, 375 to 377 is the recent bottom end of the range that the bulls must defend on a closing basis. If we break and close below here, there's really not a whole lot of support until you get down to those contract lows from September near 365 3/4. Now on the flip side, 385 to 387 is the barrier that the bulls want to see consecutive closes out above. If they can achieve this through this week's trade, potentially that spurs some short covering from the funds. It can get us back moving in the right direction. But as I mentioned, money flow and technicals favors the bear camp here near term. Hopefully that can change with a positive report today.
Well, and there's not really much news here to move the market one way or the other. We have been exporting some corn, but if you look at the export inspections, we're still running behind from where we usually should be this time of year.
Yeah, and that's one of the things why we're kind of putting a bigger emphasis on the technicals and the money flow here recently, is because it's just that time of year where there isn't a whole lot of new news. It's really going to jolt anything massive. So we're just kind of trending sideways. Money flow and technicals, those levels that I pointed out for corn, going to be very important through this week's trade. On soybeans, we bumped up against resistance yesterday, 888 1/4 to 890. There were some reports and rumors that China was in the market for 2 to 3 cargoes of U.S. beans. And that resistance pocket was significant. That was the breakdown point from January 30th. We weren't really able to attract any new buyers out and above there, so we failed right there. That's a lower high, not necessarily a good sign. 875 to 880 is an inflection point. If the bulls can't defend this on a closing basis, potentially there's new lows for this move.
What do you think of wheat? Because Egypt did not come to the United States for this last round of looking for any wheat, and are we still priced out of the market because of our strong dollar at this point?
You know, I think that is certainly part of the factor here, and we've been talking about this on your show for the past couple of weeks, forming a bearish head and shoulders pattern. 565 to 567 for that March Chicago contract is the right shoulder that we failed to really get back out above. We're testing support this morning, pre-report 548 to 550. This is the 50-day moving average. More importantly, the trend line from those contract lows back in September. If we break and close below here and continue to kind of see strength in the dollar, I think that opens the door for a potential whoosh over the next couple sessions and into next week's trade into the mid-520s.
All right. Well, we'll be back in just a moment. Stay with us. We'll see what's going on in the livestock trade. Get Oliver's thoughts there next here on the Market Day Report.